At the start of 2020, stock markets were really high. They had too much energy, and stock markets, they need to breathe. They need to dissipate their excess energy, or else no one would buy at such high prices. So a natural healthy release of energy or sell-off was expected, but no one anticipated the coronavirus would push it down even further. When the coronavirus gained traction, it played a huge impact on the global economy, dropping the stock markets in the first 2 months by almost 30%. To give you an idea of the impact, back in the 2008 financial crisis, markets dropped overall 54%, and during the Great Depression, 90%. This virus really caused a lot of problems within the global economy, and here's why. Intelligence for your life that you can share with your friends. It's BRBScience. So before we get started, hit the like button, share this video, and subscribe to my channel because I find useful tidbits for you that you can use in your daily life. To answer this question, we first need to understand the stock market. The stock market is the marketplace where people sell parts of their company called stock or shares to customers, like you and me. Like a fish stall in a seafood market. I sell fish and you buy fish. Imagine having a company and you want to gain more cash so that you can use it to buy other things to make your company grow. A way to get that cash is by taking your company, dividing it into little tiny pieces, and then selling it to others. Now, when a customer, you, purchases a little piece, you now hold something of value. That valuable piece you bought is worth whatever the company says its little pieces are worth, and the company gets its worth by how much money it makes. So, with this whole COVID-19 pandemic, a lot of fear happened in a very short amount of time. Now, the marketplace is based on human interaction. Whether it's the fish market or the stock market, you need people to go there and buy things. That action of people buying things is called demand. The more demand you have, the higher the prices go because the vendors can see that they can sell their goods at a higher price, so they raise that price. So this action of demand is based off of human interaction, and something we know about humans is that we are very emotional. When COVID-19 hit, the governments of the world put in a lot of regulations to try to stop the spread of the virus, such as closing schools, events, conferences, and even workplaces. And what all this did was promote fear and prevent people from going out to buy things. People stayed indoors and reduced their interaction with malls and other public spaces. And this has a negative effect on businesses because now businesses are forced to close, partially or temporarily, because there are regulations to force them to, and also there are no customers. And all this means is that there is no money and ultimately no demand. And also within the internal business itself, companies were sending employees home, cutting hours, and even stopping production altogether. With all these fears and regulations, people are not spending and also not earning. And this affects the emotional aspects of humans. It creates a very fearful and paranoid mood. With the stock market, it's a very moody place. When people are happy, they tend to invest their money, which is why after a company announces good news, people usually pour their money back into it. But when people are fearful, they don't invest because they're not in the mood to risk losing. So, when negative news after negative news after negative news keeps on coming, people take what they can. They curl into their shells and they wait it out, and it becomes a trickle effect, eventually leading to everyone doing it. So people are taking their investments and selling their stocks, and when the stock market drops because demand is no longer there, the companies keep lowering their prices. It creates a domino effect and everyone starts to sell, ultimately leading to the markets crashing. Now, the government has various plans to prevent another Great Depression from happening, like cutting interest rates. Interest rates are the monies you earn by putting cash into savings accounts. It's those few extra dollars you get. When the government wants to slow down people from buying and borrowing loans, they raise the amount of passive money you earn in a savings account. And that's because too many loans creates too much of individual risk, such as if you lose your job and you can't make the payment anymore, all that cash is lost and it causes everyone else to lose. All that risk is what caused the 2008 recession. So to prevent that, the government promotes saving by increasing interest rates, so you earn more dollars when you save, and this reduces investing and borrowing of so much money. The opposite is true too. When too many people are saving, the government takes away the interest rate so that people don't earn those dollars in their savings account, and it forces people to seek elsewhere to earn money like investing. So that's what the government did. They slashed interest rates in hopes of promoting economic growth once more. Overall, the coronavirus dropped the value of stocks significantly, promoting even more fear amongst the world, and only when the mood changes to a happier one will stock prices rise again. So, there you have it, intelligence for your life that you can share with your friends. And care to learn more? I have even better videos coming your way. Then subscribe to BRBScience for your answers to everyday questions.